Hi, my name is Pete Hahn, and thank you for watching this tutorial video. Be sure to visit www.hahn-tech.com for the full library of video tutorials. I hope this video increases your knowledge and helps you become more efficient with this topic, whether for home or work. Please support this channel by sharing these videos with your friends and colleagues.
Hi guys, welcome to the video. The last video I published on this series called Market Technicals was dated February 27th. And boy, there has been quite a lot that took place since the last time I published a video. So we're going to be using the on-demand feature to step back in time and look at the charts as they were on the date that I published the previous video so that we can walk forward a little bit and understand how things changed over the last 3 weeks. And I want to go ahead and show you some technical aspects of the market, what worked, what didn't, where the technical levels are failing and where the technical levels are working. I also want to show you some updates that I've made to the indicator that I'm building for market corrections. Still haven't decided on a name for this indicator yet, but what I'm doing is adding the capacity to do strategy and backtesting now using these market correction levels. And this is a really good time for me to cover the disclaimer, which is I am not a professional trader. I am not here to teach you how to trade or how to be profitable in trading. I'm a software developer. I just happen to know a great deal about stock markets. So nothing in this video should be considered an advertisement or a recommendation to buy or sell any financial instrument. Trading involves risk, and that risk means that you may lose all or more than all of the money you have deposited in your broker's account. And one more thing I wanted to cover before we get into the details of the video, I wanted to show you the spreadsheet that I keep track for the market corrections. You can see this is the one that I published back in February 27th. This was the last video that I published. You can see that I had marked off in gray those areas of correction level the markets had achieved. And we've got another one here that I can show you. And this one is the current levels for market correction. You can see they only go up to 20%, and you can see that the Dow has been down 38%, the Nasdaq has been down 30%, S&P 500 has been down 35%, and the Russell has been down 43%. Okay, so that's what I wanted to show you. This is kind of the genesis of this entire video series. I used to just publish a spreadsheet and post it to Facebook, and now I decided let's build an indicator so that we can get this into the hands of multiple traders and let them measure these levels for themselves so that they can get the pulse of the market and understand how these technical levels are being bought or sold during these market corrections. I think it will help people to not feel so apprehensive when the market starts to correct. Instead, they'll feel a little bit better about understanding the different levels. Like for instance, if we stay above the 15% correction, then it's a very healthy market event. But if we go below the 20% as we have recently, you can see that that happens when there is a devastating impact on the economy. Okay, so let's go ahead and get back into the details of the video. So let's go ahead and take a look at the dashboard very briefly. These are hourly charts except for the VIX in the upper left. We've got the US index futures on the top row. We've got euro currency, bonds, gold, and crude oil on the bottom. I use this dashboard to give me an overview of the market. As you know, bonds are usually the go-to asset for people that are running for safety, and gold is usually an asset that people run to when there are inflationary concerns. You can see gold is now up to almost $1,750 an ounce. Quite a big jump there. And a few weeks ago, I purchased some GLD and OILK. Those are the ticker symbols of a ETF that tracks gold as well as one that tracks the crude oil prices. So go ahead and take a look at when I purchased those and how those positions are doing. So let's go ahead and move to the other charts, and then we'll go ahead and flip on the on-demand feature to go back in time to February 27th. Okay, I've just refreshed the chart here, so now we are looking at the charts as they were on February 27th at about 3:51 Eastern. I'll go ahead and press the pause button so that way the charts aren't moving around. It uses up less resources on the computer. Just wanted to show you guys, it's just the on-demand button here. That's all I did was click on the on-demand, and then you click on the calendar, and you can select whatever time that you want to go back to, and then you can go ahead and look at the charts just as they were on that particular date and time. Now, there are certain functions within the platform that are not available during on-demand feature, so keep that in mind. But the on-demand feature is very handy if you want to get a look at what the markets look like at a previous point in time. So let's go ahead and move over to the charts so that we can examine the market technicals indicator. And actually, I don't really know what to call this indicator yet. It is an indicator that displays market corrections and the various levels for a market correction. I'll go ahead and expand this a little bit here, maximize that. And we're looking at a symbol of SPY. Now, SPY is the ETF that tracks the S&P 500. And I'm using that because I want to review the put that I purchased. In the previous video, you will remember that I mentioned buying a put on February 18th, which I'll move the cursor here on the chart so that you can see which candle on the chart was where I purchased that SPY put. It was a 190 put that I purchased on SPY. Here is a screenshot showing the purchase. Okay, so I purchased that single put. It was it was a 290 strike price, a put of 290 strike price that I bought on February 19th. And then on February 28th, I closed it out. Now, that's a day after I recorded the last video. In the last video, I gave you guys some ideas on where I was looking to take that put off and collect the profit. Now, you can see the difference between the price here, and it's a single contract, but you multiply everything by 100. So I made a net about $1,700 on that put. Now, that might sound really great, but there was a whole lot more that I could have made if I'd have just held on to that. But you don't know what the future is going to hold, so you got to make the choices in real time. And so I stuck with my plan, which was to hold until SPY fell to about the 290 area, which I anticipated ahead of time would be a 15% correction in the market. So what we'll do next is we'll step forward to February 28th so you can see exactly what the charts look like when I took that put for a profit. Let's go ahead and minimize this. And we'll go ahead and update. So you can see this is where I purchased the put on February 18th. And as the previous video mentioned, there was a reason why I bought that put. But at the time, you didn't see any of this correction here taking place. It was still new all-time record highs. And we even made a new all-time record high just before that big collapse came down. So it was just perfect timing. It was, just every once in a while, you get something right. What do they say about a broken clock? It's right twice a day. So there you have it. Let's go ahead and move this over to February 28th so we can see what the chart looked like at the close of the market. Let's go ahead and take this over to 1451 hours. Okay, so we'll go ahead and hit OK. Okay, so you can see that what I did is I took that put out right as we were at the 290 level. Now, it wasn't the dead low of the day, but it was right at about the 15% correction. You can see the 14% level here and the 16% correction level here. And so this is right about the place where I took that put off. Okay, so now what we want to do is see what happened after that. And when we hit the 16% level, what did the markets do? Let's go ahead and advance it 1 week into the future. So we're going to go from February 28th to March 6th. We'll hit go. And you can see this really worked out quite well. At this point in time, I was very excited to see that the put worked out extremely well. I felt that, wow, I picked the bottom. That was fantastic. And then what happened? The markets came from this 15% correction level, actually almost down to 16% correction level, and hit the 50% Fibonacci retracement of this prior move. Those lines are plotted automatically by this indicator. And so we've got the 50% level, the 61.8, the 78.6. Those are going to be resistance levels. As you can see, they worked extremely well. So technically speaking, this was very, very healthy. The market was expected to have strong buying from 10 down to 16%, which it did. And then as prices rallied higher, we expected to run into resistance right here at the 50% retracement level. The difference between these two lines, the 61.8 and the 50, is called the ambush zone. Okay, that's the ambush zone. and that is where you will have strong resistance. In other words, people are taking profits that bought down here, and people that bought way up here are taking off positions as they start to get back to break even. All right, so I just wanted to show you that's how that played out. And before we move the chart to the current day, let's go ahead and examine that. I mentioned earlier in the video that I purchased some positions on gold and oil ETFs. So let's go ahead and advance the on-demand to that date and time and take a look at what gold and oil looked like when I made those purchases. Okay, so let's bring up a screenshot where I captured this purchase of GLD. I purchased OILK on the same date, which was March 19th. So let's go ahead and change the on-demand to 319, and then let's look at a chart of GLD and OILK. Let's minimize this. We'll go ahead and switch the date over to the 19th. There we go, 19th of March, hit go. And so now that the page is loaded, we can see on 319, this is about the point where I purchased GLD, and we can go ahead and look at OILK as well. We'll load that up. Okay, and then here's the chart of OILK. Now, I just realized something, that I showed you how to turn on the setting for showing your trades, but we're in the on-demand feature, and that doesn't show trades that took place in my live account. So what I'm going to do is we're going to cancel this. We're going to leave that setting on the chart. I just wanted you to see what the charts looked like at the time I made that purchase, okay? And then we're going to go ahead and turn the on-demand feature off. And when the chart loads, this will now display. Okay, and for whatever reason, it's not showing my trades on the screen as it usually does. I don't know why that is, but you can move the cursor over here. I'll do that for you so you can see 319 was this candle right here. That's where I purchased the shares of OILK. And you can see that we've still made a few, a little bit lower lows. We went up quite a bit here and then hit some resistance and then fell back down. So net, that's about flat. It's down right now today, but it's been up for most of the time since I made that purchase, aside from this little dip here. But my gamble is that oil is never going to be $0 a barrel, and eventually they'll fix the supply and demand issue, and this is a long-term hold. Okay, I'm not planning on selling this anytime soon. It's not like a swing trade or anything like that. This is one of those things where you get once in a lifetime chance to buy crude oil when it's at $20 a barrel. Okay, it's probably not going to happen again as long as we live. If it does, then it's going to be a much more disastrous situation that we're currently experiencing, right? Let's go ahead and look at the GLD. And you can see with GLD, the 19th is this candle right here. So I purchased GLD right here when it was at this point. And you can see that gold has done extremely well. So I've more than made up for any losses on the oil trade through the gains on the gold. And you see that GLD has made new all-time highs here. We can go ahead and look at that in the futures market. Let's look at the futures contract for gold. And same thing, okay, so you can see that GLD and the gold futures contract are mirroring one another. You can see the 19th is right here. This is where I made my purchase for the GLD shares. And lo and behold, this indicator showing the correction levels is very relevant. You can see that prices originally were rejected at the ambush zone, but they gapped up and over. And then later when it pulled back, guess what? That previous resistance now became support as we pulled back down into that ambush zone. Support came in and drove the market higher. So this market corrections indicator, and I still don't know what to call it. I don't think that's a good name for it, but I hope that you guys will add some comments in the section below this video telling me what you might want to call this. It shows the correction levels. It shows 52-week highs. It shows the Fibonacci retracements and extension levels. You can see that this Fibonacci extension level here, the 123.6, is functioning as a very strong level of resistance. And I would sell a covered call against my GLD position right here, but I only bought 10 shares and I can't do a 10 share covered call. Okay, let's look at the crude oil futures market. And again, I'll mark here on the chart, the 19th is right here. This is where I bought
the OILK ETF that tracks the crude oil. You can see that it played out much the same, so it is tracking very well with that commodity, and I'm just going to have to wait it out. Now, this is a very depressed market, as you can see, and we've got a long way to go before we get to the ambush zone, but this is certainly, the $50 to $55 range is certainly within the ability of the market to reach sometime in the next year or two easily. So I feel really good about these positions. Okay, so that's all that I wanted to review on the positions. Let's go ahead and look at this indicator, and I want to show you some details that I've added. For instance, I mentioned early on in this video that I was building out something that allows you to do backtesting. So let's go ahead and take a look at that next. So let's go ahead and bring this back to SPY right here for my list on the left, and then we can collapse that so we've got a really good view. So you can see this is where I bought the put way back here on February 18th. And then this is the market correction, and the buying, the support came in and bought the market here, and we hit the ambush zone here. And notice how as we continue to make new lows during this correction, the 50%, the 61.8, the 78.6, all of the Fibonacci extension and retracement levels are adjusting as the market makes new lows. So that now, as the market is rallying, have you wondered why we rallied strong last week and we got to this level and have stalled out? Have you wondered why we've spent the last 4 days chopping around and not going anywhere in the market? It's no coincidence. We're right here at the ambush zone, okay? Now we can look at the other major indexes and see how that level has been in play. We'll just go ahead and look at the Dow Jones Industrial Cash Index. Same thing here, 1, 2, 3, and now 4 days failing to get up into the ambush zone. Very strong resistance. The Nasdaq is going to be a bit of a surprise, and you can see that the Nasdaq actually gapped up. See the Nasdaq at the 50% retracement level, resistance, 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 and then boom, it popped up and tried to break free of the ambush zone and then got pulled right back down into it. So game's not over yet for the Nasdaq. We could still see new lows from the Nasdaq. Let's look at the S&P 500 cash index, very much like the SPY, so we don't need to review that too much more. Let's look at the Russell 2000. Russell 2000 usually leads the other market indexes, and you can see that it made an extremely lower low during this market correction. This is actually well into bear market. Remember what I told you from this series of videos, the 20% correction level, anything below 20% becomes bear market. So the Russell has been firmly in bear market now for over a month. And you can see it hasn't even scared the ambush zone yet. Okay, so now I want to go ahead and switch back over here to SPY, and we want to look at the backtesting results. Let's go ahead and minimize this. And I want to go ahead and switch over to this other chart. This chart shows the strategy orders. Okay, and I've got a very conservative strategy order here. Now, I'll go ahead and go to Studies, Edit Studies, and we'll go ahead and we'll look at the settings that I have set up. Strategy buy level, level 1. Now, the levels here correspond to the correction levels. So 10% correction, 12% correction, 14, 16, 18, 6 would be your 20% correction level. So wherever you want to buy, that's where you set that, okay? Strategy sell. Where do you want to sell? You can sell at any of the Fibonacci retracement levels or Fibonacci extension levels, okay? Remember, the Fibonacci extension levels come into play after the market makes new all-time highs, all right? You've got trade size here, and you got a trailing stop and a catastrophic loss percent, okay? And we can see how that comes into play when we examine some of these other instruments. Okay, so let's go ahead and cancel that, and we'll cancel that. So you can see right here, long entry, long exit. What does this correspond to? Well, let's go ahead and shrink that down a little bit so we can see that, and then I'll bring up this other chart that I have. And this one shows a buy and hold strategy. We'll go to Studies, Edit Studies, and we'll look at the code for this. This is called buy once. It's just a temporary strategy that I built, and all it does is it buys on the first bar of the chart. So I have 5 years of data on this chart. That means that 5 years ago, it issued a buy order, and it's a buy and hold. So it gives you an idea of what would happen if you would buy and hold.
versus the other strategy, which is buy at a retracement and sell when it hits resistance. We'll go ahead and hit cancel and cancel. So that way you can see these, okay, and understand side by side the difference between buy and hold. You've got a total profit of $6,700 versus buying very conservatively at a 10% correction and selling at the 50% Fibonacci retracement, and you end up with $5,600. So you're in the market for far less amount of time, meaning you have your capital at risk far less amount of time and a far less degree of risk, and you've got almost the same amount of profit. Before we review some other instruments, let's go ahead and look at this side by side. I'll go ahead and open this up a little bit so you can see both of these at the same time. We're going to zoom in here so that we have about the same amount of data on both of these two charts. And you can see here this long entry. I'll put the cursor here and you can see that the crosshairs are showing that I purchased that right at the 10% correction level, and I sold as soon as it bounced into the 50% retracement. Okay, that's how that worked, and that's what that is recording. Now let's say I wanted to buy at the 12% correction level. Well, I go over here to the strategy settings and I edit the settings, and instead of buying at level 1, I buy at level 2, hit apply and OK. And now you can see that I purchased here a little bit lower and it's made a little bit more profit. Now the problem though is that as soon as it went back down and hit that level again, it did another entry, another long entry, but it hit my catastrophic exit. All right, and so it ended up less profitable than the other way. All right, so let's go ahead and adjust this again. Edit studies. And then let's say we want to sell at retracement 3. Apply and OK. So here you can see that we entered at the same place. We did not exit at a profit when we hit retracement level 2, which is the 50% level, because we have the strategy set to wait until we hit the top of the ambush zone at 61.8. So we hit the catastrophic loss instead, and there's the results. Now at some point you can adjust these so that you get to, let's say we do extension 1. Okay, so this is making new all-time highs is what this is. Okay, so we buy at a 14% correction. Notice the average correction over this past 5-year period, there's been 3 corrections for a maximum correction of 20% and an average correction of 15.9%. We'll hit OK, apply, and OK. And you can see how the profit profile on the bottom adjusts accordingly. Now, if we wanted to look and see how that worked out over time, we can maximize that and we can double click down here and we can see this is buying at the 14% correction, selling at the new all-time high. Again, buying at the 14% correction, selling at the all-time high. It's actually the Fibonacci extension level 1, which corresponds over here on this chart. Let's go ahead and double click that. It corresponds to this yellow, orangish yellow line right here, the 123.6. Okay, so it's saying buy here at the 14% and sell at the orange line. Buy at the 14%, sell at the orange line. Okay, so just so you understand the flexibility involved, I'm not going to go over this exhaustively. The idea is I'm building a tool that allows you to examine these different levels of support and resistance, these technical levels of support and resistance, and try to research and understand how could you arrange a strategy that gets you a similar amount of profit to buy and hold without the long-term risk associated with long-term buy and hold. Okay, so let's go back to the strategy and let's flip through some of these other instruments and let's look to see how would this have done if we had done this with the Russell 2000. The Russell 2000, there's some drawdowns here. You can see the orders are plotting, and we can go ahead and look at the Dow, all right, the diamonds, DIA, and you can see here that I've got a mistake in the language of the code here. Okay, so that profit was unachievable. This is what happens when you do a video on something that is in development. That needs to be corrected, obviously, and it's a simple fix that I can make. And I'm not too embarrassed to show that to you, but you can see that that profit there would have been a little bit less, but overall, very profitable over the long term. Let's look at the Qs. That's the Nasdaq. Okay, so similar thing. So this allows you to do research. It gives you the statistics that tells you what the average correction amount is, and then from there you can experiment with the different levels for entry and exit, as well as adjusting the catastrophic exit, so you can understand how to optimize your current trading methodology. Again, I'm not trying to teach you how to trade here. I'm simply showing you a tool that allows you to do your own research and understand how to make your own trades. Okay? So again, this is still in development. As you've seen, there's some errors there, but it's something definitely that I'm working on, and I can hardly wait to the point where I can start publishing this indicator for the rest of our viewing audience. And guess what, guys? I just checked the time for the video, and we are done. We're out of time. I wish I had more time to go over some bonus material for this video, as I have done in previous videos, but we just are out of time. And I really appreciate you guys taking the time to watch this video and follow along in this series. I really appreciate all the comments and suggestions. I know that many of you are really looking forward to when I'm ready to publish this market corrections indicator. I still don't like the name market correction. I don't know what you want to call it, but perhaps somebody out there has some ideas, and you can leave some comments letting me know what you might want to call this market correction indicator that shows the correction levels, the Fibonacci extension levels, and the Fibonacci retracement levels. The market technicals, that's it. Okay, so guys, thanks again for watching. Stay tuned for the next video. Take care, everyone.
Thank you for watching this tutorial video. Be sure to visit www.hahn-tech.com for the full library of tutorials. I hope this video increases your knowledge and helps you become more efficient with this topic, whether for home or work. Please support this channel by sharing these videos with your friends and colleagues. Thanks, and take care.